Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all the viewers of Capital Futures and to everyone online. Today is December 17th, already Wednesday, the 3rd trading day of the week. I have 2 topics I'd like to discuss with you all. First, we'll look at Amazon's self-developed chips and the competition and cooperation within the entire AI industry. The second topic is how to view the potential impact of the Bank of Japan on the US stock market. Because over the past few days, there have been ongoing reports that after the Bank of Japan released this kind of information and made such statements, they've actually been communicating with the market for quite some time. And Ueda Kazuo, the governor of the Bank of Japan, had previously hinted or suggested that this Friday, which is the December central bank meeting, there might be a rate hike. In a bit, we'll explore together what potential impacts this could have, or how we might respond to them. Alright, let's take a look first. Actually, since last Friday, when the market didn't hit a new high and started to trend downward, some investors have been worried, wondering if this rally has temporarily come to an end. First of all, if you look at the Dow Jones yesterday, it was a bit weaker compared to the other 2 major indexes, so let's set our expectations a bit lower for it. It dropped 0.62% yesterday. As for the other 2 indexes, the S&P 500 fell by 0.24%, which is pretty average in terms of performance. There wasn't any particularly obvious or panic-driven selling pressure. Alright, so the relatively stronger one is the Nasdaq 100. For the Nasdaq 100 index, around the 20 and 50-day moving averages, there seems to be some buying interest, and it looks like there's a gradual buying momentum building up. So we'll keep watching over the next 3 trading days, including today, Wednesday, Thursday, and Friday. Especially on Friday, we can expect things to be more volatile than usual. Especially on Friday, if the Bank of Japan's announcement is in line with everyone's expectations, then maybe the volatility will be a bit lower. But if their wording is stronger, or if they remind the market about further rate hikes, especially at a faster pace, then things could get more turbulent. In that case, things could get more serious. We'll take a closer look at that in a bit. As for the Nasdaq 100, it was actually the strongest among the 3 major indexes yesterday, performing quite well. There were also some individual stocks within it that did pretty well. Alright, let's first take a look at what's happening in the tech industry. According to 3 people familiar with the matter, Amazon is in talks to invest $10 billion or even more in OpenAI. Wow, so Amazon. Actually, Amazon is an e-commerce company. As an e-commerce company, its revenue is actually quite impressive, so investing $10 billion is, I believe, relatively affordable for them. So by putting this kind of capital into OpenAI, the hope is that if OpenAI goes public in the future, its valuation could exceed $500 billion, which is a huge number. Amazon probably wants a piece of that pie. It's also said that Amazon's investment will help OpenAI pay for part of the already committed cloud service rental fees. So what did he say? Over the next 7 years, starting from 2025 or 2026, and possibly extending to around 2032. With a market value of $38 billion, AWS is Amazon's cloud business. By leasing servers, AWS has become one of the 5 cloud service providers for OpenAI's AI development. We'll take a look at that in a bit. First, which are these 5 companies? If we talk about chips, for example, because when it comes to supplying such large companies, it's probably the clear leader, NVIDIA, or maybe AMD, which is catching up from behind. Also, the chip-making business itself is considered part of this. There's always been this momentum to keep pushing forward. Next, there's also training, which refers to Amazon's own chip development. It's been getting some media attention recently. And of course, the 5th company is the one everyone knows. Whether it's these chip companies or the companies working on AI, how are their chips actually produced and manufactured? And what kind of cutting-edge processes are used? Of course, that's TSMC, Taiwan Semiconductor Manufacturing Company. Everyone is already very familiar with this. Now, this chart here actually shows, remember, earlier we mentioned Amazon? What you see in the front are all figures that have already been released. For example, this black line here represents revenue. Let me see, their revenue in the most recent quarter was $175.2 billion. As for their latest quarterly earnings, it's $2.12 per share. Now, looking at the future curve, in the short term, regardless of whether it's analysts or others, major investment banks, when it comes to investing in them and looking at their future, whether it's for the fiscal year or the upcoming quarter, have made such forecasts. As you can see, it's expected to go up a bit first and then down. Now, this situation, actually, if you look at the past few quarters for them, it's not really uncommon, nor is it a rare occurrence. Let's do a quick calculation. A bit of fluctuation is normal, but overall, it follows this trend line and continues to develop gradually. Let's take another look at its stock price chart. Back in early November, when it hit a high of over $250, it then started to gradually decline and consolidate. Alright, so recently, for example, yesterday, it closed at around $222. But right now, it's fluctuating within the lower range of the interval, without any clear direction. If we look at the yellow or green moving average lines, we can see that the price is basically moving sideways, consolidating. Next, let's take a look at another company that's also a contender in the chip industry. Similarly, it's also chasing after a very strong competitor like Nvidia. Here we have NED's revenue and earnings situation, as shown on Bloomberg. If we look further at the revenue, especially the black line here, it's about $9.31 billion, and it keeps climbing. Whether it's in new business areas or the chip sector, it's continuously capturing new market share. Since Nvidia holds an absolute dominant position, any additional market share it can grab is a new advantage for it. Next, we see the orange line here, which represents its earnings per share in the US market. The latest financial report shows it at $1.21. There's also a chance that in future quarters, it could break through even further. Now, let's take a look at AMD's stock price chart. Yesterday, it closed down 0.77%. Relatively speaking, around mid to late October, it reached a relatively high stock price at that time, getting close to around $260. However, more recently, by mid to late November, it dropped to the $200 range, meaning it started with a 2. When it got close to $200, the decline stopped. Let's take another look. There is also some news about SpaceX, which is another company under Elon Musk, the founder of Tesla, and it might see further new developments. Of course, its main business is in whether it's satellites in the space sector or communications-related business. In 2026, what new developments will it have? Well, according to insiders, employees have been told that the company is about to enter a regulatory quiet period. Why is that? It's because these employees are not allowed to publicly discuss the company's future plans for going public, including its growth prospects or company valuation. This restriction applies to interviews, meetings, and even on social media. So it's actually pretty strict. This is to comply with the regulations of the US Securities and Exchange Commission. In fact, there are only about 2 weeks left until 2026. It's coming up fast. But as for the specific timeline, it still needs to be announced further. But obviously, doing this now is really to get employees mentally prepared. Of course, for these employees, this should be a good thing, because more or less, they might have some so-called stock options or other incentives, whether it's in terms of compensation or rewards. So for them, this should be a potential benefit. Alright, let's take a look. If we're talking about space-related topics, we first have to look at Tesla, since SpaceX hasn't gone public yet. Tesla's stock has just hit a new high. At the close, the increase was 3.07%, which is quite a strong performance recently. Alright, let's take a look at what space-related ETFs are out there. Here's one, an ETF with the ticker symbol UFO. It covers quite a lot, including stocks related to the space sector and satellite communications. Let's take a look at which ones are included. For example, there's ASTS, which is Space Mobile, or companies like Normalstar. These are among the top 3 holdings. Then there are others like EchoStar. For rockets, there's RKLB, which most people have probably heard of. And then there's Trimble and SiriusXM. Some of these companies aren't even listed in the US, like Garmin and others. Actually, the top 3 holdings make up about 20% of the total weight. Let's take a look at how their stock prices have performed recently. Of course, if investors are really interested, you can look them up one by one. There are ticker symbols listed here, right? You can go online and search for the official websites of these individual companies as well. That way, you can find out what each company mainly focuses on. In terms of future space applications, are they more involved in signal processing, telecommunications, networking, or even satellite launches? You can dig deeper into the details and specifics of each company's operations. So let's start by looking at ASTS. Its stock price increased by 0.83 yesterday, which is relatively above flat. As of now, there doesn't seem to be any obvious positive news, so it's possible that in the coming months, for example, if SpaceX really does have plans to go public and continues to make it public, and if the market, investors, or even Wall Street media openly, well, maybe not hype it, but at least bring out related positive news, then for the industry as a whole, it would be a major piece of news, and there's a chance that some companies could benefit from it. Also, as for Planet Labs, its performance in the past couple of days has been just so-so, but when it comes to last week, it actually performed quite well, with a significant increase. So, as we can see from its chart, yesterday's drop was 0.94%, but considering its current stock price level, it's actually at a relatively high point compared to the past 6 months. It's already gone up quite a bit. On the other hand, looking at GSAT, which is called Global Star, its stock performance yesterday was the weakest among the three, with a drop of 7.75%. But if you look at the trend chart, you can see that its upward movement is more in line with the traditional pattern of rising more and falling less. Occasionally, after a few days of gains, there will be some pullbacks, and after consolidating for a while, it continues to rise. Overall, the uptrend is actually quite steady. But as of now, if we look at the moving averages, it's roughly around the 20-day moving average. Today is actually a very important point to watch, especially since SpaceX has released such an exciting piece of news. So will it react accordingly? We'll just have to wait for the market to open at 10:30 and keep monitoring it during the trading session. Alright, so in terms of industry trends, according to a report by The Information, several sources directly involved with Apple and its suppliers have revealed that over the next 2 years, meaning 2027 and 2026 in the UK, Apple will significantly expand its smartphone product lineup. And this product line is only getting bigger and bigger. By the fall of 2027, they might launch at least their first new flagship model. The first one could be a foldable phone, since right now iPhones haven't released a foldable model yet. Other brands have been rolling out foldable phones one after another. Whether it's phones from mainland China or other more common models, they've all been releasing foldable devices. The general market response has been pretty decent. Nothing too extreme, but it's considered a new kind of experience. Alright, so Apple has said that the iPhone will be announced in the fall of next year, which is the fall of 2026. That's actually only about 8 or 9 months from now, so it's not really that far off. Plus, as we get closer, the media will gradually start covering it, like unboxing videos and so on. There might be so-called early leaks, or, for example, people who are already in the know, whether it's from the supply chain or employees working inside, who start revealing things like the technology or roughly what the specs will be. They might not go into great detail, but they'll let everyone know like, oh, so this is roughly what the new product will look like, and what kind of features it will have. Now, the media has already revealed in advance that its width will be greater than its height, meaning it will look like a small iPad. Okay, so let's take a look at what other products are going to be released. It seems like in the spring of next year, which is about 3 or 4 months from now. Everyone is talking about the 17 that's coming out, and then the 18 Pro or Pro Max that's set to launch next fall. Of course, these aren't confirmed code names or official names. They might end up choosing something new, so these are just temporary placeholders. Then in the spring of 2027, a little over a year from now, they'll release the 18 or 18.1. And as for the 20th anniversary edition, the iPhone 20, we don't know if it'll actually be called 20. There's a good chance it'll be something really special. As for what it'll be called, it's mentioned here that Apple is also planning to introduce this kind of, well, new form factor for the iPhone. And the camera lens will be placed under the screen, meaning there won't be any visible lens on the display. You won't see any missing section where the camera is. It's going to be a true full-screen iPhone. Alright, let's take another look. The latest important financial events and economic data. On Monday, there was the New York Empire State Manufacturing Index. Yesterday, I mentioned the non-farm payroll data and the unemployment rate. So let's take a quick look at those. So a bit later, there might be the number of people applying for unemployment benefits, and then there's the CPI, as well as Friday's University of Michigan Consumer Sentiment Index, and the short and medium-term inflation expectations. All right, let's take a look. Non-farm payrolls and the unemployment rate. Yesterday during our live stream, we also mentioned that the November non-farm payroll number was 64,000. Actually, compared to our estimate and Bloomberg's market estimate of 50,000, it's a bit higher. If we look further back, the 100,000 figure, which was a negative value, refers to the situation in October, where it actually turned negative. It decreased by 105,000 people. As we can see here, November saw a significant increase of 64,000 people, while October saw a decrease of 105,000. A drop of 105,000 is quite a noticeable decline. But because we now have the November numbers, people might not pay as much attention to the October figures. Next, since there are still more than 40 days until the January meeting, the media's focus will likely shift to the December numbers. Alright, let's take a closer look at the unemployment rate, which has also risen to 4.6. This shows that volatility in the job market has further intensified. If we look at the chart, it might help everyone understand the situation better. In the chart above, the area above the purple line is what we're looking at. The non-farm payroll numbers. You can see that starting from January 2024, in about 4 or 5 months, the monthly increase in new jobs has been above 200,000 people. However, since January this year, starting from 2016, there have been no months with more than 200,000 new jobs. There have even been months with just over 100,000, maybe about 5 times, and only about 4 times where it exceeded 100,000. More recently, there have even been 3 instances where the number was negative, meaning there was no job growth at all. In fact, there were job losses. For October, the data released yesterday showed a negative 100,000. So is the job market really cooling off? This brings us back to what was mentioned on Monday, whether the Fed might, just like in 2020 and 2021, be underestimating the inflation situation in the future. Back then, inflation was clearly already starting to heat up, but the Fed still believed that inflation was only transitory, just temporary. Because of that, they missed the opportunity to curb inflation early, which later led to aggressive and hawkish rate hikes. So this time, could it be that employment is already starting to cool down, but the Fed still doesn't realize it, or is even underestimating it? This could be a concern we need to watch out for in the future. However, if there are such concerns, it's actually not entirely bad news for the market. Why? Because if the Fed really is underestimating things, then in the future, it might be forced to cut rates even more aggressively. In other words, take more rapid action to save the entire economy and job market. But if the Fed has learned from its previous experience of underestimating inflation, or has taken lessons from last time, then just like in his last 3 rate cuts, he would first take a risk management approach. After that, he would gradually and cautiously monitor the numbers and data, and continue to maintain his consistent approach, making sure of the numbers first. If there really is no problem, or if there really is a problem, then he would cut rates accordingly. What he wants is for his approach to be correct, not necessarily fast. So if that's the case, and we're still in a rate-cutting cycle, then for the stock market as a whole, it's not really bad news. In short, as long as inflation or core prices don't keep rising, the Fed won't have to go that far. If it gets to the point where rate cuts are paused or even reversed into hikes, that's still a relatively neutral to slightly optimistic outlook for the stock market. Looking at the US unemployment rate below, you can see that since 2024, it's been gradually rising and has even surpassed the 4.5% mark. The latest figure announced is 4.6%. Will it keep moving toward 5%? It's hard to say right now and needs further observation. But you can see that actually since 2024, the rate was even below 4% at one point. Up until now, we can clearly see a gradual, steady increase. This even includes what Trump previously mentioned about layoffs in the public sector, or the buyout plans, which led some public sector employees to either retire or move to jobs in the private sector. This may have also partially affected the unemployment rate. All right, let's take another look. So from a trader's perspective, after yesterday's non-farm payrolls, how do these numbers add up? November's figure was slightly higher than the market expected, 64,000 compared to the forecast of 50,000, while October showed a clear negative value. Looking at the trend, it's the October line, followed by November. But does the situation in November make traders change their view a bit? What we see is that they still hold on to the belief that before September 2026, there might be 2 rate cuts. That's what traders currently expect. Whether it's their capital allocation or their forecasts and expectations, that's what they're relying on. What we see is that under the scenario of about 2 rate cuts, by next September, which is about 9 months from now, since there are only 2 weeks left until 2026, so a little over 9 months, there's still a chance. Of course, the exact timing is still uncertain. This is still up for debate. Sometimes the Fed wants to see further new employment reports, which could bring new surprises or unexpected results to the market. For example, if the data for June turns out to be really bad, they might immediately adjust their plans. It's hard to say for sure. Alright, and sometimes even the shift between dovish and hawkish stances by each official can happen very quickly. For example, I saw Goolsbee say that he originally voted against it in December. The reason he gave for his opposition was that he wanted to see more data. Alright, so he saw the November data as well. After seeing the November data, did he change his stance? Yes, he said that if the economy in 2026 is still quite strong and inflation hasn't picked up, then he thinks it's possible to further lower interest rates. In other words, he's not being as hawkish anymore. Alright, let's take another look. So here we have the Dow Jones stocks from yesterday, showing which ones performed better and which ones performed worse. As we can see, actually, the best performer was Disney. Nvidia, Boeing, and Johnson & Johnson also did pretty well. On the other hand, the ones that didn't do as well yesterday were mainly affected by some financial stocks being adjusted or facing selling pressure. For example, Goldman Sachs, JP Morgan Chase, even 3M, Chevron, and Johnson & Johnson all dropped more than 2%. Among them, United Health also saw a relatively large decline. So yesterday, some of the larger cap companies like Goldman Sachs were among those affected. Along with United Health, they were impacted by this kind of drop, which dragged the Dow Jones down. On the other hand, if we look at the SOX, the Philadelphia Semiconductor Index, the better performers were the labs, and Applied Materials also did pretty well. These were all among the top performers yesterday. As for the ones that didn't do so well, that would be Intel, AMD, and Micron. They were the weaker performers yesterday. Of course, will it be the same today? We'll have to wait and see. Before the market opens, the futures for the 3 major indexes are looking fairly optimistic and positive, with gains ranging from about 0.2% to 0.4%. But for more details, we'll have to see how things look at the 10:30 opening, because sometimes if there's heavy selling pressure in the spot market right at the open, it can quickly drag the futures down. But if there's buying in the spot market, it's also possible for things to go the other way. In that case, the futures could get pushed up as well. It's really hard to say. Things can change in an instant. Alright, let's take a look at the international stock markets and some key investment news. So what about the president of the European Commission? Ursula von der Leyen had some responses to the recent criticisms from the US president regarding Europe. She voiced her own rebuttal, urging Europe to forge its own path in this changing world. But what did she say? Because Trump, previously he called the leaders of Europe and the EU rather weak. Of course, he was referring to the bigger ones, maybe like Russia, France, leaders of that sort. Alright, so he said that the new national security strategy claims the EU is facing the demise of its civilization and economic decline, which is pretty serious wording. He asked, will European civilization really disappear, or will the economy even decline? What kind of situation will it end up in? But von der Leyen also pushed back. She said, actually, this isn't the first time people have realized that the post-war world order is undergoing changes beyond imagination. What does she mention? In the report, which refers to the National Security Strategy report, she said that Europe's share of global GDP has dropped from 25% in 1990, which is about 30-some years ago, to around 14% today. But she added, it's not just Europe. The same thing is actually happening to the United States as well. It dropped from 22% to 14%. So both the US and Europe, these two developed, advanced regions, have experienced this. Naturally, the ones taking their place, whose share of global GDP has increased, are the emerging countries, such as China and India. So in these kinds of emerging markets, of course, there are also some places in Southeast Asia that are performing quite well, like Indonesia and the Philippines, among others. Now, this situation actually doesn't mean that the national strength or economies of the US and Europe are getting weaker. It's just that there are other economies in the world that are rising with even more momentum over the past 20 or 30 years. This is something we can't deny. That's just how it is. Now, does this mean that the relationship between Europe and the US has changed, or has it become more strained? Not necessarily. Because, in fact, the US still hopes that Europe will support its role in the Russia-Ukraine conflict. The US is working hard to take the lead, and Trump has always wanted to adjust the US-Europe relationship to reach a peace agreement between the two sides, and further promote a ceasefire. Of course, looking at the current situation, we just need to consider one thing. Russia still has a slight advantage on the battlefield right now. So if you think about trying to patch up their, whether it's about ambition or his passion for expanding territory, he'll definitely think the more the better. In other words, he won't be easily motivated to agree to a ceasefire. On the other hand, Ukraine's constitution also stipulates that actually the Ukrainian president cannot just give up territory at will. In other words, the core interests of both sides can't really be fully aligned. First, Russia's willingness to agree to a ceasefire is already low, and the chances are slim. Ukraine also doesn't want to cede any territory. At most, they're just suggesting a ceasefire along the current line of contact. So it's already possible that an agreement can't be reached. Therefore, given the situation, even if the United States tries its best to mediate, it's still not certain that anything will happen within the remaining 2 weeks of this year. In fact, the war could even drag on until 2026. All right, let's take a look at this week's company earnings reports. There will be some related explanations from Len a bit later. On the 18th and 19th, there are some key stocks to watch, especially in the memory sector, Micron, ASML, as well as Nike and FedEx. Okay, let's take a look at the stocks that are up or down in pre-market trading. In pre-market trading, the stocks with more noticeable gains are Micron Technology, Hayabusa, and Jabel. On the other hand, the one with a more significant drop is Len, which is Lennar Homes. It's considered one of the top real estate developers in the US. Okay, let's take a look at why that is. It's because they announced their earnings per share, which came in below the market and analyst average expectations. That's why the stock started to fall in pre-market trading. So what was the market expectation? $2.24, but what they reported was $2.03. So there's a small gap there, which is why the stock is temporarily down in pre-market trading. Of course, we still need to keep an eye on it after 10:30 to see if the decline continues or even gets worse, because sometimes the trading volume in pre-market hours is still pretty low, and liquidity isn't quite there yet. It's really after hours trading where the real action begins. All right, let's move on to today's second topic, the talk about an AI bubble and the Bank of Japan's upcoming plan to raise interest rates. Are we worrying too much about this? Western securities mentioned that concerns over an AI bubble in the US stock market could actually amplify the impact of Japan's interest rate hike. In other words, previously, Japan relied on having one of the lowest interest rates among all the major developed countries in the world. This led to a large amount of borrowing in yen, and even converting it into assets in relatively more advanced or developed markets. For example, US dollar assets, which tend to have higher interest rates. Let's not even talk about when Japan's interest rates were close to zero. At that time, the US still had interest rates of several percent. Not to mention, now US stocks are near record highs, so it's really not surprising that there are such comments. But here, he mentions that if the US experiences 2 or 3 consecutive rounds of declines in both stocks and the currency, it actually raises some suspicions. In other words, if US stocks drop, US bonds drop, and the US dollar also falls. Is that what he's suggesting? He says that in such a situation, you could sell your assets, but if you wait until then to sell, the prices probably won't be very good. So actually, just take this as something to listen to. He says holding currency, that is cash, and waiting for a liquidity shock. In fact, because the market is so short on funds, this liquidity shock might even force the authorities to introduce a clear quantitative easing policy. As for taking the opportunity to increase asset holdings, I don't really agree with that statement either, because the authorities have already said they'll handle and resolve the liquidity issue. So only when the lack of liquidity becomes even more severe will the authorities be forced to implement even more quantitative easing. At present, the only real reason the Fed would go for even more quantitative easing is if the employment situation gets worse, and also if inflation keeps moving toward the target, or at least stops rising. In that case, the Fed would have a chance to implement even more quantitative easing. As for the liquidity shock, it probably won't be the main reason, so maybe people are worrying a bit too much about it. Let's take a look. Looking at Japan's 10-year government bond yield over the past 5 years, we can see that starting from 2021, every year and every quarter, it has gradually risen, then leveled off, risen again, leveled off, and continued climbing. Now it's almost at 2%, and breaking past 2% is probably just a matter of time. So why is this Japan's 10-year bond yield, which is already considered a medium to long-term government bond yield, continuing to rise? Has the US stock market kept dropping because of this continuous increase? The answer is no, because just last Thursday, it hit a new high. Doesn't that seem to fit better with this chart, or at least make more sense? Alright, so if people think that US stocks will fall just because Japanese government bond yields are rising, or because Japan is going to raise interest rates, that's probably not very likely. In fact, I think even if there is a reaction, it would probably just be a short-term one. So there's no need to worry about this. Meanwhile, market expectations are more widespread and comprehensive. Why? For example, in August last year, 2024, why did the market see sharp selling pressure? It happened suddenly, a surprise attack, and the market wasn't prepared. So when arbitrage and interest rate differential trades unwound, what happened? The selling pressure just erupted, and it caught everyone completely off guard. There was no time to react. People sold off all their stocks, or at least most of them, within just a day or two. That's why that situation happened. But now, this news has already been communicated to the market, probably for at least a week or two, so everyone already has this expectation in mind. So when the news actually comes out, could it actually be a case of all the bad news being priced in already? That's something for everyone to think about. Capital Bank is expected to raise interest rates to 0.75% at the monetary policy meeting on the 18th and 19th. If you look at it, according to multiple sources, the Bank of Japan believes that even after this ongoing rate hike, the financial environment is still relatively loose. I think what they mean is that it's loose in a relative sense, compared to other major countries. And they're also expected to continue with their rate hike plans. You might find it strange. How can the environment be loose and yet they keep raising rates? But this is all relative to other countries. So looking at it this way, since these news pieces are from sources like local Japanese news, the perspective is a bit different from what you might see in Europe or the US. Actually, if things were always this clear and straightforward in Japan, it wouldn't be a problem. The governor of the Bank of Japan is also taking an open attitude toward discussing a rate hike at this month's meeting, which is happening in the next couple of days. So why is he changing his stance? Why is there an adjustment? It's because public opinion and inflation are really forcing him to loosen his position a bit. Maybe he just doesn't want Japan to raise rates so quickly. He said that Japan's consumer price index, even after excluding fresh food to get the core CPI, has been above the Bank of Japan's 2% target level for 3.5 consecutive years. In other words, it's been higher than 2% for 3.5 years now. For such a long period, it hasn't been within their target range. So many people in the market even think that if they raise interest rates now, it's already too late. Kind of like how the US previously underestimated inflation. Now, with Japan's current inflation, the Bank of Japan is also actively responding. Some analysts have pointed out that when the Bank of Japan raises interest rates, of course they'll do it in a more gradual and cautious manner. It's possible that they might raise interest rates about once every 6 months, following that kind of pace. He also said that the current environment is completely different from 30 years ago. Back then, after the bubble economy burst, the central bank had to lower interest rates to stimulate the economy. Alright, he said that now the Japanese government has made dealing with rising prices in Japan its top priority. And when we look back at this top priority, we see that it's related to public opinion polls. Because we know that if the cost of living keeps going up, it's something that every person or consumer feels in their daily lives, whether it's pork, gasoline, rice, or any of the food they eat. These are things they have to spend money on every day. These are things people see every day, so if prices go up, then the public opinion polls for the Kaohsiung city government might become a bit shaky. Actually, things are still going pretty well right now, so they probably don't want rising prices to affect their poll numbers. Even though he's already working really hard, just looking at his daily routine, he actually doesn't get much sleep, and most of his time is spent busy with government-related matters. Alright, let's take a look at this. This is EWJL, which is a Japan-related ETF. As you can see, actually, in the past, except for 2022, because the aggressive interest rate hikes by the US caused a more significant pullback, other years like 2023, 2024, and 2025 have all risen quite a bit, just like the US market. In 2024, it took a bit of a breather. So if we really have to say, the trend of US interest rates actually has quite a big impact on the Japanese stock market. Of course, that's just Japan. As for the US stock market, as I just mentioned, no matter how Japanese interest rates move, US stocks still hit new highs. So actually, the impact you could say might cause some fluctuations, but it's not that significant anymore, especially when the market has already anticipated it. If you're still really worried about what to do, if you're afraid, if investors are concerned or fearful that there might be a downturn in the future, one thing you can do is to adjust part of your holdings. So adjusting part of your stock positions. For example, if you were fully invested before, you could sell down to 70% or even 50%. That's what we're suggesting here. Even if you convert part of your stock holdings into cash, you still have some stocks left. Do you really want the remaining stocks to go down? Of course not. You'd still hope that at least it continued to rise steadily, right? And you still have time. If you see that things have stabilized, or if the volatility isn't as bad as you expected, you can always buy back in. Hey, even if the market really does drop by 3 to 5%, let's just say it happens. If there's some panic selling and arbitrage trades are being unwound and more positions are being released, wouldn't that mean you're buying back at an even cheaper price? Right? If you really take out some of your funds now, you might even have the chance to buy some stocks at a lower price later, or invest in new stocks you're optimistic about. Of course, your original 50% stock holdings might take a bit of a hit, but at least you'll have 50% cash on hand to make new moves. And if you're still really worried, you could even lower your holdings to 30%, because everyone's tolerance for risk is truly different. Some people just can't handle too much loss. If they see the index drop 2 or even 4% in a single day, their heart just can't take it. In that case, you might need to reduce your overall position size, not just focus on stock picking or looking at moving averages and technical analysis, because this already involves the investor's psychological resilience, or in other words, how much of a downturn you can actually handle. Some people might have nerves of steel. Even if they see their assets shrink by 18% in a single day, they don't really feel anything, and might even sleep soundly. In that case, their risk tolerance is probably quite high. So, as I mentioned earlier, everyone has their own way of adjusting to these situations. Some people haven't really entered the market at all up to now, or since the low point in April, aside from the reversal in tariffs and the whole taco incident, for example. Maybe they only have a small position in the market, maybe just a single layer of holdings. So do they need to wait? Of course, they can just wait and see, because they only have that one layer of holdings. Even if the market goes up and doesn't continue to fall and instead hits a new high, well, that's fine too. It won't really have much of an impact on them. In fact, if it hits a new high, they might even feel happy about that single layer of holdings reaching a new high, right? Honestly, every investor thinks differently, so it's hard to generalize. All right, that's it for today's session. Good night! We hope that in the next 2 trading days, everyone can follow the trend and make trades accordingly. If anything unexpected happens, you should also be prepared to handle it during the trading session. Likewise, you can start by gathering a lot of information. Relevant industry news, financial report trends, and even evaluating the competitiveness of individual companies, all of these can be assessed. Also, whether you use line charts or analyze market data, you can observe and gather insights. All right, I wish everyone smooth trading. Thank you all. That's it for today. See you tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.